Hi, everyone. Thanks so much for joining. A little bit of a calmer start to the week. We've had so much to digest. Everything from political ructions in the UK to surging bond yields. The oil price remains elevated. There's Strait of Hormuz remains closed for the 11th week. And then on top of that, we have a lot of earnings data, and we had a really sharp stock market sell-off last week. But let's dive straight into the charts and we will just see what is going on. So we are starting with the oil price. So the oil price has been, this is just literally a 5-day oil price chart, just to show you the direction of travel. Yeah, there we go. Right, you should hopefully be able to see it now. So it shows you the direction of travel, which has very much been upwards. We peaked around over $111 per barrel this morning. This is Monday, the 18th of May. And that was because over the weekend, we had some really harsh rhetoric again from Donald Trump. Yet that harsh rhetoric is not transforming into a peace deal. Secondly, we had news that there were drone attacks on the UAE, which potentially could have come from Iran. So that ceasefire just looked very, very fragile, and no peace deal. Still got the Strait of Hormuz closed. That has really put upward pressure on oil. Now, as you can see, it has dipped back to the $110 per barrel mark. Now, we need to wait to see the fact that there hasn't been any more drone attacks, the fact that Iran doesn't come out and said that they are going to break the ceasefire. It's probably giving a little bit of hope to the markets. But I think that as we move through May, and through Q2, there's real concern that the oil price remains comfortably in triple figures, and actually right now comfortably above $110 per barrel. So that is definitely something to watch as well. So you've got those inflation fears, but we also have, just bear with me one moment, guys. I'm going to start sharing my other screen. We also have a lot of concerns around bond yields. And if we just take a look at the UK bond yield, so last week we had that real spike higher in bond yields. If I just extend this chart, as you can see, bond yields absolutely jumped at the end of last week. That was when it looked like Andy Burnham was potentially coming in to challenge Keir Starmer, and that we were going to get left-wing politics, and everything was going to, our fiscal deficits were going to blow up because he's quite to the left of the kind of high spending wing of the Labour Party. Over the weekend, though, and I think we're seeing that play out today, we have seen a little bit of a decline in bond yields. So they're down 2 basis points. That's not really a decline. You could call it a stabilisation. Andy Burnham came out the weekend, said that he would abide by Rachel Reeves' fiscal rules, and then actually maybe the fiscal and economic policies of Andy Burnham and Keir Starmer wouldn't be too different in some cases. He kind of hinged his whole economic plan on nationalisation. Some people could say, well, that will add to our national debt because of how much that will cost. But for now, the market is kind of maybe appeased a little bit about what Andy Burnham was saying, and we've just backed away from those highs, just below 5.2%, currently trading just above 5.15%. So things are definitely kind of streamlined a little bit today. There certainly seems to be a little bit less stress in the market. Now, that's not the only bit that's going on. Let's take a quick look at where we were. Nvidia is just a really good gauge of market sentiment at the moment because US stocks sold off really, really heavily at the end of last week. Look at this, it was led by tech. We saw a 4.4% decline in Nvidia on Friday. So that is a huge decline, really. That's what pulled the index down about 100 points away from its record high. Remember, the S&P 500 had reached 7,500 last week, which is the highest ever level. It also meant that 4.4% decline in Nvidia also meant a pullback from that near $6 trillion valuation for Nvidia. This is crazy. But I point out Nvidia because it does have earnings this week. And as you can see, it is stabilized in the pre-market. So it's currently up 0.7% in the pre-market. But if we just look at Nvidia, obviously year to date, we're trading very respectable 18% increase year to date. So it's tracking higher than the overall market. But if I compare that to AMD, which is another chip producer in the US, one of the best performing stocks in the S&P 500 so far this year. look at it, 90% gain year to date. So it's nearly doubled in price year to date. So there's really been, compared to other chip stocks, which have really been leading market higher, certainly in the last couple of months, Nvidia has been much more restrained in its gains. We do have the earnings report coming out later. We have put out our preview. That was in our week ahead, and we'll also do more as we lead up to the main event. But the focus is going to be on, can they beat expectations? Because remember, with Nvidia, it's never can they just match expectations. Everyone wants them to beat it and beat it by a decent margin. Can they beat expectations? And what are they saying about forward guidance? Forward guidance is expected to be 87 billion for this quarter's revenue. So it's absolutely huge. This is because they're transitioning from their Blackwell architecture to their Vera Rubin architecture. And so far, what analysts are gauging anyway, is that transition is going very well. Vera Rubin costs more, so that should boost revenues into the future. So expecting some nice, big, chunky numbers. Another monster earnings report. It's also worth noting Jensen Huang is essentially considered like the Steve Jobs, really. Do you remember back in the day, Steve Jobs would take to the stage and it could have a big impact on Apple's share price, but kind of the share price for the whole of the US. Jensen Huang has really taken into that role, much more so than any of the other big tech CEOs, I would argue, maybe not so much Elon Musk. So he will also be talking on Wednesday night when the earnings are released. And there are three things really to look out for. Number one, what is the uptake of agentic AI? So that's kind of the real, AI that can actually do things that enterprises can buy and that can change their whole workflows and their whole profit outlook, really. What's that doing? Secondly, has their customer base widened? And then thirdly, what about kind of tariffs and China and the China market? Now, these expectations, by the way, for forward revenue for this quarter of 87 billion does not include the Chinese market. But we have just heard, we have just ended that US-China summit. Jensen Huang was there. We didn't hear too much about how that's going to impact the chip sector, the tech sector, those really big firms in the US, but we might hear a little bit more from Jensen Huang this week. So we're going to be watching that super closely. Now, I'm going to go back to my X station. Sorry for all the chopping and changing here, but it will be worth it, I promise. So here we are, we're back with the oil price. Let's just take a look at gold, because gold's just been one of those assets this year that has just not really taken off. Now it's had quite a decent run over the past year. It's been trading around about just above that kind of 3,200 level. We're currently trading at 4,500. So over the year, it's making really good gains. But over the last few months, it's kind of stable. It's just moving sideways. Gold is boring. After being the most interesting, record highs at the start of this year, it is now just trading sideways as you're seeing this rotation in the commodity space out of gold and into oil. And I think for quite a while, people thought that the oil price, actually this would all be saved and something would happen that would not lead to such a bad outcome, that the war would be sewn up really, really quickly. Well, as it's not sewn up so quickly, I think investors are still holding on to oil, which then limits the upside for gold. So gold just drifting, really. As you can see, it's trading around about that 4,530 level, 540 level thereabouts. It's just a bit uninspiring. So I think, that's where we see it continuing in its tight range. The other is the US 100. Obviously, we're looking at that. So we've got the US 100 here in oil. They're tracking each other pretty closely, interestingly enough. If I just get rid of the oil price there, you can really see this is the tech stock. I mean, yes, this is the tech index in the US, the Nasdaq 100. It has pulled back for sure. If I just move it back here, you can see, but it's off really high peaks. And what a fantastic run since April. There's no denying that. If I just add into that the UK index, you're really seeing something a little bit different. UK index is higher on a year-to-date basis, but it's just not really been able to recover back to those pre-war highs, even back to those April highs. We just have kind of drifted lower. The market hasn't been so interested in what the UK has had to offer because we don't have much tech. This is a pure tech-driven rally. Now, some people will argue that this pullback in the last few days, as you can see here, if you follow my pointer, in the Nasdaq, is possibly a sign that US indices don't do very well when US bond yields rally, because it's not just UK yields that have been rallying and surging in recent days. It has been US ones as well, even though the UK is definitely the worst and bad bunch. But you have a situation whereby some people are now worried that the rising bond yields will just puncture these real strong gains in US equities. Right now, though, we're still not seeing too much of a rotation into UK equities. That doesn't seem to be on the cards. There doesn't seem to be too much interest in what the UK has to offer. Now, that could change today. As I said, we're seeing a little bit of an increase in markets. Markets are certainly stabilising. The UK bond market is stabilising. The pound is stabilising. And so too is the gilt yield, obviously. So that's just UK markets are stabilising. They're not recovering, but they're just not selling off anymore. We'll just take a quick look at the pound there, because obviously it was at its had its lowest level for 5 weeks, but it has kind of bounced back just a little bit. It's currently trading at 133.50, so it's up about 50 pips on the day. It had been hovering around that 133 level. In the very short term, 133 looks like really, really good support, with 136 as resistance. The fact that we couldn't break above that 136 level already had the writing on the wall, even before Starmer's demise. And so it did suggest that maybe there was kind of a limit to pound upside. But now it looks like we've made a nice bottom there at about 133. And I think that over the summer months, we're going to oscillate between these. I think probably the peak now will be about 135. I don't see us getting back to that 136 level, which was totally rejected 3 times, 1, 2, 3, this month, so far this month. So that's definitely something to watch out for. Now, I just realized you've only just seen that pound chart, but as you can see, yes, the pound, so you've got resistance there at 136, really, really strong. 1, 2, 3 times it has been, the market has not been able to puncture above 136. And on the downside, you've got 133 there. We've picked up from that low, so that does suggest pretty solid support, on the downside at 133. And I think we really will, as I said, like kind of trade within this range, certainly until we know who the next prime minister is, until the market is a bit more calm and stable. I probably see 135 as being the peak, though. I don't think we'll get much more above there if we are to see a more prolonged recovery, especially now that Andrew Burnham doesn't sound so concerning to the bond markets, because I just think when you reject a level 3 times, that is a firm rejection of that level. So guys, thank you so much for joining. Lots going on this week. Watch out for those Nvidia results. We will be covering them. Please follow us on YouTube, and also follow all our analysis. We'll be on socials, and of course we'll be on the website as well.